let's huddle up with our money huddleists. Heather Zumarraga is back with us as well, and so is Seth Denson. All right, so John Tobacco is a bear, guys. Is anyone a bull here in this crowd? Heather, what do we think? Are we headed for a crash in the market?
Well, I thought you were going to let John on the segment with me so he and I could hash it out, because John and I love to battle and have a bull versus bear debate. I can really honestly argue either side. I mean, the markets are extremely volatile right now. The NASDAQ up over 2% today, as well as the S&P close to being up 2% as well. But that's on the backs of NASDAQ was down over 20% in bear market territory. So if you're a short-term investor, if you're a day trader, this is what you want to see. So you can buy when things look really bad, and you can sell when the market's up on a day like today. But if you're a long-term investor, it's really unnerving. I get that the economy, especially after the GDP print this morning, is not doing that well, but I mean, John, you got to look at it in an inflation situation. It's forcing people into risky asset classes like the stock market because there's nowhere else to go.
Seth, calm us down here. We're talking about crashes everywhere. Heather's not even fighting with John Tobacco in the bulls and bears scenario. I need some comfort. Is there any to be found?
Long-term, John. Long-term is where your comfort is. If you're trying to play short-term in the market, you get what you get. Go to the craps table. John's playing shorts. He's the guy that plays the don't pass line. I'm the guy that plays the pass line. That's the way we do things. But here's the deal. Long-term. If we think long-term, here's the deal. The NASDAQ over the last 5 years is up over 100%. The S&P over 75%, and the Dow's up over 60%. Long-term is where the game is, and it always comes back. Nobody would have dreamed in 2008 when the big short was going on that we would see markets where they are today, but they've gotten there. We are going to see a dip. Do I think we see 26? No. Do I think that maybe 28 is in the realm of possibility? Sure. But long term, we're going to see it back up and more than it is today.
Yeah, you know, it's always good to look at the 25-year scale, 30-year scale, and that's the time period most of us are going to be investing as we're working here, and it always keeps going up. But that said, Heather, in times like this, people are very concerned. They don't know what to do. But there's still value in the market, you think?
Right. Well, look, if you're in the market, I think you stay in the market, and here's why. Because the market is a forward-looking indicator. It's anticipating that R word, recession. It's anticipated inflation. And so although I'm not optimistic on the economy or, for example, policies coming out of the Biden administration, I mean, the stock market, 2 weeks ago and last week, we had a big decline across the board in all of the indices. So, I mean, I don't think this is the time to get out of the U.S. stock market. If you didn't, you missed it. And I think it's a forward-looking indicator. There's $8 trillion of stimulus COVID money that was printed over the past 2 years. That has to wind down. And look at the alternative at bonds. The Federal Reserve is raising rates at a very slow pace. So if you want to entice me to sell my equity positions, I got to see interest rates move a lot higher than they are.
All right, and they're slowing that up a little bit. Now, we can talk about the foreclosures too, Seth, and there's some comparisons being made between now and 2008. Just in March, over 33,000 properties across the U.S. faced foreclosure. Is there a difference between now and 2008? Because you hear a lot about these purchases. A lot of them are being made with cash, not these crazy kind of adjustable rate mortgages that we had back in 2008.
Well, that's it. You had adjustable rate mortgages. You had lenders without any guardrails on what they were doing. If I made $30,000 as a cashier at Kroger, I could go buy $1 million house, and that's just insane. That was what was going on in 2008. The difference here is to what Heather alluded to. There's tons of cash in the market, and if there's tons of cash in the market, if I'm an institutional investor, I'm not going to, and the markets are doing what they're doing, I'm not going to take cash out of the market when I can borrow at 2 and 3%. I'm going to go grow an asset, let's say in Texas, where I'm borrowing money cheaper than I'm gaining it in the market. And now I've got two assets. And in places like Texas, where the housing market has increased over 20% last year, right? That was a good investment. Here's where it's bad. Here's where we're going to see bubbles. Major metropolitan areas with bad policies, high end and high cost. Because if I live in Seattle, I can't afford a 6, 7, 8% interest on $1 million house on top of the $1 million house. That's where we're going to see these crashes. That's where we're going to see foreclosures. This is more money. This isn't predatory lending like we saw in 2008.
Yeah, also, I guess, Heather, inventory is still pretty tight in the housing market. It's a little different than in 2008 when, at least down in Florida, you would see all these houses going up and no one moving in. Different time, I suppose. Great to see you both,
Absolutely.
Seth and Heather. Next time we will set it up. John had to go shoot his show, Wise Guy, so he couldn't be with us the whole time. But we'll definitely get in there.
He could have Heather and I on next time. We'll make it work.
The Rumble.
Yeah, Bulls and Bears. A little old school.
Right.
All right. Great to see you all.
Got it. Good to see you.
Thanks,
Take care.
John.